e.l.f. Beauty stock is down 48% in the last 3 months. That has a lot of investors asking if they should buy e.l.f. Beauty stock on this dip here. Now, I'll evaluate the company, its latest quarterly financial results, and look at the company's longer-term results. I'm going to highlight one key risk that I noticed at this company, especially in the latest quarterly results, that could have caused this big stock price decrease. And finally, I'll weigh that all against its valuation to determine if long-term investors could buy this stock on the dip here. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so here you have e.l.f. Beauty's chart over the last 3 months, down 48%. And unsurprisingly, I've been getting a lot of comments from my viewers asking me to evaluate e.l.f. Beauty stock and answer if the stock is a buy. Now, I haven't visited e.l.f. Beauty stock in some time. The last time I visited the stock was more than 6 months ago, and I told investors not to buy. And so I'm going to see if I'm changing that recommendation here following this huge stock price decrease. Now, I wanted to start with the big red flag with e.l.f. Beauty, because many investors are understandably considering the stock because of this big dip here. And I want to highlight why I think the stock price is dipping. And it has to do with advertising expenses, or what it calls selling general and administrative expenses. They lump together advertising in here along with the general and administrative expenses. And what you'll notice is this category doubled or nearly doubled in the latest quarter, which ended June 30th. 180 million in spending in advertising or SG&A, up from 92 million in the same quarter last year. But sales didn't increase by all that much. Sales increased from 216 million to 324 million. Or in other words, sales didn't double like SG&A doubled. Sales increased by roughly 50% when SG&A increased by 100%. So you don't like to see that. That's evidence that the company's having to spend a lot of money to maintain growth. And that's concerning because when you look at the operating income, you'll notice even though sales increased to 324 million from 216 million, operating income actually decreased to 51 million, down from 61 million in the same quarter last year. So they're having to work a lot harder to generate these sales. And then what made me a little more concerned is that the management team was highlighting the fact that they've demonstrated 22 consecutive quarters of sales growth and market share gains, putting the company in a rarefied group of high-growth consumer companies. So this means to me that this company's management is really focused on growth. They want to make sure they're growing the business, increasing market share, and even if that means spending more to achieve that growth. So if the company's organic growth is not at the level they want, they don't mind increasing spending to achieve those growth levels, which I'm not in favor of. Typically, I like to see companies go after profitable growth, go after the low-hanging fruit. Don't chase growth, especially don't increase SG&A by 100% year over year to achieve growth. The company's already growing. Do you need 50% growth? Could you have grown at 25%? Maybe, but that's just my opinion. Management, of course, knows better about its business than I do. Looking ahead, the company increased its outlook for 2025, raising the revenue number from close to 1.3 billion for 2025. That's up from 1.24 billion, which was the previous outlook. Interestingly, profitability, adjusted net income forecasted at 199 million, let's say 200 million, up from 190 million from the previous expectation. So the company is expecting to do better in 2025 than it previously thought, and that's good news for e.l.f. stock investors. Now, management believes its shares are undervalued. It announced a 500 million share repurchase program, and typically when a stock price dips like this and management talks about feeling their shares are undervalued and they go out and they increase their share buyback program. Remember, the previous buyback program was only 25 million, and now they upped that value to 500 million. So a huge increase in the share buyback for e.l.f. Beauty. Now, growth is definitely here for e.l.f., right? $13 billion in the trailing 12-month period. Revenue, that's up meaningfully from around $250 million in 2019. And remember, this is not a software, this is not a technology company, this is a cosmetic company. So to achieve this level of growth in this category is impressive, to be sure. Unfortunately, this level of growth is not leading to improved cash flows from operations. It's in fact moving downward. In 2020, the company's cash flows from operations were closer to 20%, and they dipped considerably during the economic reopening and then jumped back up to 20%, and now they're falling again. So you don't have consistent improvement in cash flow from operations with e.l.f. Beauty, even though the company is growing very nicely. The growth is coming at the expense of spending in some situations, like you saw in the latest quarter. If the company sees the quarter is not going as planned or as expected, they don't mind increasing investments in advertising to achieve these growth levels. Looking ahead, the analysts on Wall Street expect the company to increase its earnings per share by 17% each year over the next 5 years, and that would be roughly 1/3 of the profitability growth the company achieved in the previous 5 years. So the analysts on Wall Street that are following e.l.f. stock expect its growth in earnings per share at least to come down considerably, even if they don't think the company's revenue growth will slow down. They do think the earnings per share growth is slowing down considerably. Return on invested capital had been improving for several years with e.l.f. Beauty, and you can see that trend reverse, and it's heading in the wrong direction now. When you have a company that's demonstrating this kind of trend line in return on invested capital, it's going to get investors excited, it's going to get investors enthusiastic. But when this trend reverses, that's going to be a major downside. It's going to be a major letdown for investors who will now feel that, you know what, the company achieved its peak performance. It cannot achieve that performance any longer. The growth is now coming at the expense of too much spending. The easier growth opportunities have vanished, and the next leg of growth might be too difficult to achieve at profitable levels, meaning you can still grow the business, but that growth is going to come at the expense of your efficiency, of your profitability, and increased spending, increased asset intensity, etc. And that's what could be happening with e.l.f. Beauty, and that's why the stock price is down as much as it is off its highs. 15.81% return on invested capital is not bad on its own, but what's worrisome is the trend downward. Is this the end for e.l.f. Beauty's improvements in return on invested capital? That remains to be seen, but the trend downward in itself is already concerning investors. And lastly, valuation. The company is trading at a forward price to earnings of 25, which is more reasonable. It's less than half the more than 60 forward price to earnings it was trading at earlier. It was trading at a peak valuation of over 60 forward price to earnings, which in my opinion would have been way too much to pay for a cosmetics company, regardless of its growth prospects, regardless of the growth performance over previous years. And now at a forward price to earnings of 25, it's a much more reasonable valuation. So to answer the question if I think e.l.f. Beauty stock is a buy, hold, or a sell, I would say the stock is a hold right now. I want to see where those trend lines go in terms of the spending on advertising and the changes in return on invested capital. I want to see how those evolve over the next couple of quarters before I can upgrade this stock. Or if this valuation falls, if the forward price to earnings falls into the high double digits, meaning like a forward price to earnings of 18 or 17, that would be a lot more attractive, and I can see myself upgrading e.l.f. Beauty stock if it begins to trade at a forward price to earnings closer to 18 or 17. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.